So we're going to look at the capital markets. Okay, we've looked so much about the money market. Now the capital market. So we're going to look at the bonds and the stocks. So the capital market is simply the segment of the financial system where we deal with long-term securities. These are securities whose maturities are more than 1 year. So in the capital markets, we will look at um, instruments that are traded. But these markets are subdivided into the primary and secondary markets. So the primary market is where we issue new shares like bonds and shares, okay? And these are issued to investors. And the company's IPO, initial public offering. So we also have the secondary market where existing securities are bought or sold among investors, like the Lusaka Stock Exchange. So there are two main instruments that the capital market has. We have what we call stocks or equities. These represent ownership of a company, and we have bonds, which are debt securities, which represent the loans that are made by investors. So these so we'll talk about each individually and how it is computed. So we start with equities. So equities, like I said, equities represent ownership. So equities are actually shares. So shares have a way of computing them. The reward for buying shares is called a dividend. So the share is simply ownership of the company, and shareholders are entitled to dividends if declared and potential capital gains from price appreciation. So we have what we call ordinary shareholders, which have voting rights and variable dividends. And we have what we call preferred stock, which has a fixed dividends. Of course, they have priority over being paid when there's a liquidation. We also are going to look at the important formulas that are there. So to evaluate a dividend yield, it's simply the dividend paid over the current price of a share times 100. So this is how we calculate the dividend yield. Okay. This is how we calculate the dividend yield. So these are the two. And we also have other computations like earning per share, price earning ratios, the dividend discount model, which looks at computation of a dividend, and also the CAPM model. So these ones are important, and these terms that we understand them. So the models that we're going to look at very paramount for this course, the Gordon model. So the Gordon model looks at the calculation of current stock, which is given by D1 over P0 as growth. The D1 is expected dividend next year. If you're told dividend was declared this year, it is D0. So this formula can also be manipulated to as follows: D0 and plus growth over PO plus growth. Then we also have the CAPM model, which is used, it's called the capital asset pricing model. It's used to calculate the value or cost of equity. It's given by the risk-free rate plus beta, open brackets expected market return minus the risk-free rate. So in this case, our risk-free rate, in most cases, we are referring to treasury bills. So in that way, I hope we are together so far. Any questions before I proceed?
What we have done is over.
The capital market instruments, especially now we're looking at the stocks before I even go to the bonds. Are we together? Any questions so far? It's clear. Okay.
You can proceed, we are following.
All right. So now, with that being given, we can now use those formulas to calculate the price of a share So we're given this data here. Can somebody help calculate the price of share 5 max and which model we're going to use for this particular question? We've been given the beta there, we're given the risk-free rate, the market return, the current dividend, and our growth rate. So let's calculate the price of share using Gordon's and using CAPM model. So the CAPM model is given by, what's the form of the CAPM model? AE is equal to risk-free rate plus what? Plus beta expected minus risk-free rate. So what is our risk-free rate in this case? 8%. What is our beta? 0.9. What is our expected market return? 15%. And what is our risk-free rate? 8%. So this is going to be 8% plus 0.9. Here we have what? 7%. So when you compute here, what have 8%? Then we're going to have what? 63, 6.3%. So when you add these two, we're going to have 14.3%. So this is the cost of equity using the CAPM model. So who can help us calculate the cost of equity using Gordon's model? What's the formula for Gordon? So equity using Gordon's model is what? D1 over P0 plus growth. So dividend, you should be careful which one has been given. So if you're given dividend now, you use the formula D0, 1 plus growth over PO plus growth. So D0 is simply the current dividend. So in this case, what have we been given? D1 or D0? We've been given D0. And the growth rate is what? 6%. 1.06 here. And the price, what is the current price? Plus the growth rate here, which is what? 0.06. So what is our P0? Are we following? Are we together? Is there anyone lost so far? So,
It's clear.
okay. So the current price of stock is D1, D0, 1 plus growth over. So you don't have the P0, you can calculate the P0 first. Current price of stock is simply D1 So this one is the cost of equity in percentage. So we don't have the P0 here. We can calculate the P0. P0 is simply given by D1 K minus G directly. Or D0 1 plus growth over K minus G. So our 1.2 will be here, 1.06 is here. Then our K market rate is what? 15%, 0.15. And our growth rate is 6%, 0.06. So when you compute that, our P0, therefore, will become 15.31. So 15.31. So you need to understand that this is what you can use here if you want to calculate the cost of equity using Gordon's, but this is the cost of equity and this is the price of stock now. So this is in the capital market when we are discussing the computation of stock. These are the questions that you should expect when we are looking at computation of stock. We talked about preferred stock and we have equity, which is ordinary share. So if we're dealing with preferred stock, the cost of stock is simply the dividend paid over the cost of equity, over the price being paid now. So if you have a dividend that was paid, which is 8 kwacha, is selling for 80 kwacha. The cost of equity for this kind of dividend, just multiply by 10 times 100, sorry, to get 10%. So this is how we calculate the cost of preferred stock. Are we following so far? I'm trying to revise as many questions as we can from what we have been learning. So we are in the capital market. We said capital market is a combination of the bond market and the stock market. So we're looking at the stock market where we're dealing with the computation of stocks. So those are the computations that we use when calculating that. Okay. Let's go to the bond market. In the bond market, we must understand that we are dealing with fixed income what? Securities. Fixed income securities. So long-term bonds are long-term debt instruments that are issued either by a company or government and promise to pay the issuer an interest, which we call a coupon. And on top of that, you pay the face value. So there are different types of bonds. We have what we call a government bond, a corporate bond, a zero coupon bond. And there's what we call the current yield, which is the actual return that the investor gets, given by the annual coupon payment divided by the market rate. So the simplest way of calculating the value of the bond is as follows. So suppose you're given a coupon interest of 10%, a market rate AD of 8%, and the bond has a face value of 1,000. And the time for this bond is 3 years. So you are being asked to calculate the value of the bond. So the simplest way to calculating the value of the bond is simply the coupon payment, the summation of the coupon payment divided by what? The discount factor, 1 plus KD. The power of 1 and the face value at the end, 1 plus KD to the power n, the actual year. So when you're dealing with dividends, you're dealing with coupons or bonds, you need to understand that they'll pay you interest in the 3 years and give you back your money at a discounted rate in the 3 years. So the job of the small I is to produce a big I. The capital I is simply small I times the face value. So 10% of 1,000 is what? 100. So this 100, you'll be collecting it every year for 3 years. Okay? So year one, you're going to get what? What if the bond will be 100 over 1.08 to the power 1. The second year, we're going to get what? 100 coupon interest over 1.08 to the power what? 2. And in the third year, you're going to get this 100 again over 1.08 to the power 3. On top of that, you're given a bonus, you're given back your money, the actual face value, the 1,000 over 1.08 to the power 3, because that is the last year. So discover that the 3 and 3 here will repeat itself because that's the final year. So that is how we calculate the value of the bond in its simplest way. Okay, so you must also compare this here. If the coupon interest is more than the market rate, this is a premium bond. What you're going to get here will be a value more than the face value. But if the coupon interest was 3%, the value you get will be less than the 1,000 here. So this will be called a discount bond. So let's say for argument's sake, we find the value of the bond as 1,200. So this is called the premium bond. So to find the current yield, you simply divide the coupon payment, this 100 kwacha. Sorry, 10% of 1,000 is 100 kwacha. This coupon payment, 100 kwacha over the selling price of the bond, 1,200. So 100 kwacha over 1,200. This is the computation of the current yield times 100. It gives you the actual interest that is enjoyed on the bond itself. Okay. So with that being said, we'll look at an example from the exam. Together we calculate the value of a bond. Any questions before I go to an example? These formulas given? Yes, they're given. Okay. So talk about stock valuation, as I also talked about the value of a bond. So let's look at these questions here. They encompass almost everything I've talked about now. Okay. In this question, we are told number one, assume Microdrive has just paid a dividend of 1.15 stock, and the required rate of return is 13.4, and the investor expect the dividend to grow at a constant rate of 8% in future. Estimate the dividends in 5 years and the value of stocks today. So who remembers what to do here? So using the constant growth model, we want to calculate the value of the dividends in the first 5 years. So what are we given in there? What have we been given? The question. So dividend, is this D0 or D1? When you hear that just paid, that is D0. So D0 here is 1.15. What else are we given? At least identify what has been given. What is this? The KD, the required rate of return. The dividend is supposed to grow at 8% in future, so our growth is what? 8%. So you must understand that for the dividends, we've been given D0 as a starting dividend, which is 1.15. So I gave a shortcut of evaluating these growths. Okay. So dividend started at 1.15 in year 0. In year 1, year 2, year 3, year 4, year 5. 1, 2, 3, 4, 5. And the growth rate is what? 8%. So you just multiply by 1 plus R. So 1 plus R is 1.08. So just answer you get, you multiply by 1.08. So what is the dividend? D1. You can use the number line, or you can use the normal long cut. It's D0 1 plus growth. So this means the D0 is 1.15, then 1 plus G, 1.08. That is a growth for dividend in year 1. So 1.15 times 1.08. Anyone, what are you getting? 15 times 1.08. So here the dividend will be 1.242. Now 1.242 is for year 1. So instead of you redoing this long cut, since the growth rate is constant throughout, just keep multiplying by 1.08 the answer to get for the next. Times 1.08. So here we're going to have what? 1.34. We get to the next one. What do we do to this one? Times 1.08 again. What do we get? 1.45. Okay. 1.45. Then this answer you multiplied by what? 1.08. You should get 1.56. 1.56. And this one you multiplied times 1.08, you get 1.69. So these are the dividends for the subsequent years. So 3 marks for this. Then what is the value of stock? What did you say is the computation for value of stock? P0 is got what? D1 over K minus G. On D1, you just calculated 1 point what? 242. Our market rate, our K is what? 13.4. So 0.134. And the growth rate is what? The growth rate is what? 8%. 0.08. Hmm? 134 minus 0.8. What are you getting?
23.
23. Find the 23. Gotcha. So this is how we find the value of stock. So 6 marks for that. Are you together? So let's go to The second part, suppose of risk-free rate of 8%, market return of 10%, market premium of 4%, and beta of 2. What is the rate of return? So this is clearly Gordon's. Gordon's model simply says that the risk-free rate plus beta minus peak market risk minus risk-free will give you the market rate. So here, risk-free rate is 8%. We put 8% plus our beta is 2. We put 2 times market rate 10% minus 8%, that is 2. So it will give you 12%. So this is how we find this. Okay. Then discuss the efficient market hypothesis and its related forms. What is the efficient market hypothesis? Anyone who has read about it? What is the efficient market hypothesis? But I discussed this. Okay. What is meant by cost of capital? Okay, so the efficient market hypothesis is simply a financial theory that suggests that markets are informally efficient. So this means that the prices of the securities, these are shares and bonds, they all reflect what? The available information. So it asserts that some prices are they already incorporate all the information. So it's impossible to achieve something higher than average. So there are three forms. There's a weak form, efficiency, where share prices will reflect all past or historical prices. Of the semi-strong efficiency, which asserts that prices reflect all publicly available information, and also the strong form, which asserts that prices reflect all information, both public and private. Then cost of capital is basically the cost, or it's actually the minimum return that a company must earn on its investment to satisfy its investors, to satisfy its creditors, and also to satisfy other capital providers. So there are different types of cost of capital. We have cost of debt, which looks at a company that pays on borrowed funds. So now this one is tax deductible. So meaning the after tax cost is it has a tax shield. Okay, you subtract 1 minus tax. Then we have the cost of equity, which we looked at in the CAPM model, and the cost of preferred stock, which is a semi-equity and semi-stock. So now in this case here, we are asked to calculate the cost of debt. So cost of debt is given by the pre-tax cost 1 times tax. So here we're given a company decides to sell and issue a 7-year bond at 15% of the par value of 100 at par. So the company realizes the full value of $100 and will pay 100 principal to the bondholder at maturity. So compute the cost of debt after assuming a 30% tax. So here, some information is irrelevant. So what is the cost of debt? It's 15%, so 15%. Then 1 minus tax, so the tax is 30%, so 1 minus 0.13. So instead of paying 15%, you're going to pay 10.5%. That is how you calculate the cost of debt after the tax, with the tax of 30%. Then part C is asking that a company issues 10% irredeemable shares. The face value is 100, but the issue price is 95. Calculate the cost of preference share. So preference share is sometimes treated as what? As as debt. So the formula I gave you is the DP, which is the dividend paid over the price of the dividend. So we're told that this is a 10% of the par value. So 10% of the 100 is $10. So this is what we put here, $10. And the issue price for this preferential shareholder is 95. So if we remove the cost attached to it of $10 to remain 85. So 10 over 85, you're going to get 11.76%. So the last question is you need to discuss the benefits and disadvantages of what? Using debt in the cost structure. What are the advantages and disadvantages of using debt capital? I talked about them. Anyone remembers? Okay, so debt capital is simply borrowed funds. So the advantages that you would have as a company to using debt is that it retains your ownership. So your borrowing does not dilute your holding in shareholder. So it doesn't include the people you borrow from to be, unless it's a certain type of bond. Then the benefits of tax is that the interest paid are tax deductible. So in the statement of your balance sheet, there's a corporate tax which is charged. So there's a tax shield which will reduce your ability to pay double tax. So sometimes borrowing could actually be cheaper than using equity. It also is a lower cost of financing because debt is generally cheaper than equity because lenders take less risks. And it's predictable, so you know when to pay the interest and schedules. Okay, and as a flexible payment structure can arrange for short term or long term, and also encourages discipline in the sense that if you have regular payments, you push managers to use resources efficiently. The disadvantages is that debt is never good. You must repay it with interest, regardless of how big it is. You have to add money, which is painful. The other disadvantage is that there's increased risk. So if you have high debt levels, the risk of being insolvent is high. And it's restrictive. Sometimes some debt that is given comes with what? Restrictions of borrowing, and also it requires collateral. So some debt may require you to have some security. And also there's an impact on credit rating. So if you have too much debt, it can lower the firm's credit rating and make future borrowing expensive. Cash flow pressure. So regular interest and principal repayments will reduce your liquidity and will limit your investment. Lastly, but not the least, you have leverage backfires. So if a business returns and falls below the cost of debt, it will reduce the shareholder wealth instead of increasing it, but will reduce it. So this is where we end for today. I'll send you questions based on what we have discussed. Have a good evening. Thank you.
Thank you.